Hey everyone, welcome in. For those of you who are new, I'm Sean Farrell, head of digital asset strategy here at Fundstrat and Memphis Insight. Thank you for everyone for joining. Hope everyone is enjoying the plentiful green candles all around us today and this week. We appreciate you choosing us as a resource to guide you through the crypto market. And hopefully, on weeks like this, you're able to, um, you know, capitalize on this relationship. So appreciate you trusting us with that. We have a very interesting webinar today. It's a bit unique. I know that folks are probably accustomed to us having strictly crypto projects, companies, and funds on these webinars. But today's webinar is a bit different. It features a fintech company looking to build a private credit marketplace with the hopes of accessing untapped markets, specifically in the Global South. Private credit has emerged as this massive pool of capital and a very popular asset class of late. It offers very interesting, has some very interesting attributes. Higher rates, often better covenants. An illiquidity premium, as many call it. The team and Tom will go through all that today. I'm actually not going to be hosting the webinar. Tom Couture, our VP of digital asset strategy here at Fundstrat, he did all the real heavy lifting on this. So he's going to guide us through the conversation, lead Q&A. And of course, always remember, since I mentioned Q&A, remember to get your questions in as the team will try to address those at the end of the webinar. So with that, I'll bring in Tom and the RealFi team to chat about what they're working on.
Thank you, Sean. Happy to be here. Thanks for tuning in, everyone. Like Sean mentioned, private credit's been a hot asset class over the last year, so timing couldn't be better to have RealFi here. I'm going to hand it over to RealFi's CEO in a moment, John O'Connor. He's going to tell us a little bit about RealFi, and then we have a miniature product demo for you so you can see their platform, what they're building out, and then we'll finish up with some Q&A. So as we're going through, please feel free to throw your questions in the chat, and we'll try and get to them at the end of the webinar. So with that, I'll bring in John O'Connor, CEO of RealFi.
Thank you so much, Fundstrat team, and thank you everyone for tuning in. We've got a lot of exciting stuff to do here. I'll also stick in a proviso that we definitely will be talking about digital assets and crypto at the end of this. But as the team sort of alluded to, our approach is sort of fintech first, Web3 second. So without further ado, let's talk about RealFi. So what we're doing at RealFi is building a marketplace to connect up global investors with impactful private credit opportunities, specifically with a focus of emerging markets. We're an experienced team of professionals. We're a team of 15 people now, and we've really got deep expertise within product, within engineering, within credit, and within data science. We've also got both myself and Danelle, who for the last 5 years have had executive roles in Input Output, the company that builds Cardano. So we do bring a lot of that crypto experience, but we've also basically augmented that with a lot more traditional experience from companies like Meta or Microsoft. So we've got a very well-rounded team, both in the digital asset space, but also more broadly across credit and data. So what's the opportunity space here? So we sit in the middle of the confluence of the $2 trillion private credit market, the $5 trillion emerging market financing market, and the $1 trillion impact investing market. So we believe we have a TAM of $260 billion. I'm really focusing on building out technology solutions that further facilitates the movement of capital into this intersection space. But the market's big. That doesn't mean it's easy to access. So for us, the real question is, why is it so difficult to be able to access emerging market private credit opportunities? So some of the eagle-eyed amongst you might recognize this diagram, which is a reference to the Monty Hall problem. So in the Monty Hall game show, you're presented with 3 doors. 2 of them have got goats behind them, and 1 of them has a car. If you pick the door with the car, you win the car. Unfortunately, in emerging market investing, really what happens is you pick the door with the car and someone switches it out after the fact with a goat. And so what am I referencing here? Really what I'm talking about is the asymmetry of information between people who are creating these credit assets in emerging markets and the investors on the other side. And that's really the problem space that RealFi is designed to solve. And we'll talk more about that solution in a second. The second thing to say is that even though there are challenges in finding great opportunities, that doesn't mean that great opportunities don't exist. So what we have here is an example partner who we've done a transaction with recently called 4G Capital. 4G Capital is primarily based in Kenya and provides short-term working capital finance to small businesses all across the country. As well as providing working capital, they also provide training on how people can use working capital to be able to grow their business. Ultimately, 4G provides very short-term duration debt. People can buy stock with it, and then after they've sold that stock, they repay these loans very quickly. That enables 4G to be able to turn these loans across the year to be able to generate very attractive commercial returns at the end of it. And because of their data-first approach, they can also manage NPLs effectively. So anyway, this is just a transaction which we've executed, but one company isn't enough, right? So the real sort of problem space here is that how do you decide whether 4G as this fintech lender is a good lending opportunity or a bad lending opportunity? And what sort of data would you need to be able to come to that opinion? And this is really where RealFi sits. So we provide this marketplace that partners with the 2 sides of the market, investors on one side and fintechs on the other. We ingest the data from these fintechs and then use that to be able to interpret and make value judgments on both performance and impact. So this might sound simple, but in reality, it's not. For a single partner, like within this example, 4G, ingesting their loan tape, which is every single transaction which has occurred by 4G, this could be anywhere between 30 and 50 million different lines of transaction history, which somehow need to be cleaned, structured, and then, of course, interpreted to be able to make useful decisions from that. And this is really the space that RealFi looks to play. We're currently building out the platform, and we'll show you a demo of what it will look like in the future. But the 3 core components for the marketplace are the ability to be able to learn about deal opportunities, the ability to be able to see the diligence which has been performed on these companies, but to be able to go one step further as well. And what that means for us is a traditional diligence process augmented with the data insights which we get from our model. Finally, an investor who participates in the future would also be able to see live monitoring of both the performance and the impact outcomes which their capital has provided. So this is a work in progress. We haven't launched the platform yet, but we'll talk more about the roadmap in a second. So where are we currently? Well, currently what we've done is deployed $5 million of our own money across 3 lending opportunities, 2 in working capital and 1 in asset financing. And these transactions were executed by an external fund manager, Wave Financial. So we took these lending opportunities and we evaluated them with the product that I've just described. This means ingesting tens of millions of lines of transactions, cleaning it and structuring it to be able to make judgments over whether or not this was an attractive opportunity for us. And what the output of that spits out as is live analytic views of both the commercial performance and the impact outcomes. The final part of the learning for us was that as we analyze both these opportunities and many others in the market and analyze these tens and tens of millions of transaction lines, what we were able to do is to establish a framework for how we start to think about what's going to generate value within this particular working capital space. So that's it. I won't go on for too much longer. I think it's great if we can jump straight into a demo, but it's worth talking about what our call to action for this webinar is. So as I've said, currently we've been limited to a smaller set of stakeholders, mostly internal, as we've deployed our own capital. But now we're at the stage where we'd really like to broaden the number of stakeholders who we're engaging with. We're still very much in a research phase. So really what we'd like is for interested parties to be able to get in touch so we can show you more about the data models we're building, get feedback on the prototypes and the platform as we develop it, really start to understand what external investors, country, sector, impact and return preferences might look like, and also discuss how people might, basically how you as investors like to deploy your capital and through which investment vehicles. So yes, that's it at an early stage, but we'd love to get in touch with anyone who finds the overall proposition interesting. So at that point, I'll hand over to my colleague, Harry, who's our senior credit analyst, to be able to run you through a quick demo before we take questions. Over to you, Harry.
Hi, everyone. Thanks, John. I'm just going to share my tab here as we go. All right. Thanks again. I hope that's clear. Can everyone see my screen?
It's clear. We can see.
Great. Thanks, guys. So I'm Harry Plumstead. I'm a senior credit analyst at RealFi. I'm going to take us through our online investor platform conceptual prototype. So this is kind of a quick demo of the type of experience that we're wanting to create for investors. There's quite a lot of content, so I'm going to run through from top to bottom, but with a specific focus on the company analysis section of the platform. But let's just start here on the landing page first, and we'll navigate from there. So as you can see, we can see some featured deals at the top of the page. And if you scroll down, there'll be latest deals. And really an investor can just navigate up and down this page and see, if there's anything that is of interest to them or is appropriate. But some investors may wish to screen by certain selection criteria. So if we navigate to the top here, we can select, for example, by impact metrics. So perhaps an investor is interested in the number of customers trained by the company, and simultaneously rural communities served and percentage female clients of that company. So these filters are then selected at the top and applied. The platform will then suggest deals based on those parameters that have been selected. And you can see here, there's a deal suggested that is a working capital transaction. It's senior secured in the capital structure and has a term of 18 months. And it's quite evident why the platform suggested this transaction. 74% of the company's clients are female. The company has trained about 190,000 of its customers on topics in finance, and about 74% of its clients live in rural areas. So we can click into that deal where we get a very limited high-level overview of the deal and some information on the structure. So that'll start with an offer summary, a short company profile, a deal structure, some details on that deal structure, and then some examples about how the company is impacting communities through stories from their clients. But obviously, as investors, we need to look at a bit more detail than this. So what we would do is click on the company analysis tab. This analysis is behind an NDA wall, so we request access, and once that admin is done, then we have access to a more detailed analysis of the company and the deal itself. So that starts with the investment highlights. So what are the main drivers of the investment thesis? This is followed by a section on credit analytics, and here we can find a variety of metrics that will be important to investors. So both initially when analyzing the deal before investing, and then subsequently when monitoring the performance of that deal post-investment. These investment metrics include time series like the yields on the assets of the book, we need to answer questions like, is the book generating enough yield to cover its cost of capital? Or is there enough yield to more than offset any loan write-offs in the book? Will the yield provide sufficient cushion in the case of a depreciation against the dollar, for example? And will debt holders in those scenarios still get paid? We track measures like write-off rates and default rates and the stability of those over time. And then also measures that show the percentage of the expected collections in the book that are delayed and how those are moving over time. Then we need to look at liquidity measures, things like coupon coverage. So we need to answer questions like, how likely is this company to be able to pay back its coupons to debt holders? And with what headroom or cushion? And then also measures that split the clients of the firms. So we can look at those at a more disaggregated level and analyze them directly. We need to look at the profitability metrics of the company. So are margins expanding? Are they contracting? Are margins robust to economic variability? Or are they actually at quite problematic levels? We also need to look at cost drivers. So how are the costs of the company evolving over time? And then very importantly is the stability of the capital structure. So what is the asset cover like in the structure? Does it give investors comfort? Or actually should investors be concerned? Very quickly to wrap up, following the proprietary credit analytics, we also aggregate third-party impact metrics. So here's an example. This includes an impact SWOT analysis where we can again select for the impact metrics that are of interest to us. So for example, customers trained, again, % female clients, and rural customers. And then we can inspect those global benchmarks below as we make those selections. We can also see impact analyses of the company in question. This one is done by B Corp. B Corp is an impact rating firm that sets impact standards and provides impact certifications globally. Following this, we have an overview of the competitive landscape. So this compares the company in question to its closest peers. And then this analysis wouldn't be complete without a list and discussion of the risks to the investment thesis, and obviously the potential mitigations of those. So that brings me to the end of the company analysis section of the platform. Thanks for your time, everyone. And John, back to you.
And back to the Fundstrat team, I think, for some Q&A.
Awesome. Thank you, John. Thank you, Harry. That was great. A lot to chew on there. So I think something you touched on for a minute there, John, was that RealFi sitting at the intersection of private credit, impact investing, and emerging markets. So maybe we drill down a little bit there on like why investors are picking private credit and how private credit is different from some other asset classes, whether it's real estate or other alternative investments.
Yeah, I mean, to be honest, this is probably a surprise to no one on the call, but people do like the predictability of fixed income returns, of course, with better yields than what they might see for other fixed income products. So we've seen a massive explosion, of course, across this asset class across both Europe and the United States. But typically, that private credit is working with much larger companies, and that's really the debt which is being accessed. Our approach is that, can we build out this asset class, but for much smaller companies? And of course, the answer is, well, you can, but is it worth your while? Are the deal sizes big enough, et cetera, et cetera, et cetera? And our solution on this is really to use data and to build out these data models to enable us to start understanding risk for much smaller companies than you might otherwise see. So that's really our approach to it. And it's the reason why data is at the heart of our model, because it enables us to understand risk of these smaller transaction sizes than what you might have seen in larger private credit funds.
Yep, that's great. And then I guess the second part of that is you're focused on emerging markets. So like, why are emerging markets difficult for US investors? Why is RealFi focused on emerging markets? Are there better opportunities?
So, our basic thesis on this is that we've seen some very attractive commercial returns across a number of the opportunities that we looked at. But we've also seen lots of things that also are maybe less attractive. And the real question is, how do you tell A from B? And that really has been the challenge for many, many people who participated in emerging markets across a number of years. I was speaking to a friend who's 25 years of emerging markets in Goldman Sachs. And the point he made is that it's very difficult, actually, in that a lot of equities, at least within emerging markets, are set up for the enrichment of the operators versus the shareholders. And that point really stuck with me because, how do you know? Things might look great on paper, but then you participate and actually it's nowhere near as good as you thought it would be. And that's really why we consider ourselves more of a technology company than anything. Our entire model is about trying to turn that exogenous existential risk, which you don't know about, into something quantifiable and measurable. And that's the reason why a technology stack creates incremental value, I would say, in emerging markets where there is maybe more of that information asymmetry. The second part of this is, of course, that if you can meet threshold commercial return requirements, but also generate an impact, if it's not an either or, but actually you can do both, then, for us, we think that's particularly interesting. So yeah, that's why we're focused on this segment.
No, yep. And I think in the demo, we saw that you guys are tracking important impact metrics. Maybe you could speak to the struggles that impact investors have in really being able to identify where they're making an impact and having quantifiable data on that.
Yeah, I think if we were to talk more generally, I think the last 10 years have seen a lot of interest in impact investing and also ESG. And one of the challenges, I think, which we're starting to see now is a reaction against that. Not least because if something isn't quantifiable, then is it really real? We've also seen lots of accusations of greenwashing, and some of them are absolutely accurate. So our approach is, if you can't measure something, it's not real. So much like the performance history of a credit portfolio or people's ability to repay a loan is a binary quantifiable metric, our view is that impact outcomes should be the same. So as we build these integrations with these fintech lenders who we're enabling capital to flow to, we have a whole bunch of requirements for them to be able to participate with us. And part of those requirements are basically identifying data streams which will speak towards the impact which they are claiming. So just like any of the other financial metrics, impact is attestable and measurable. And that for us, I think, changes people's ability to be able to sort of claim the impact. And frankly, I think we're seeing a lot of this sort of behavior also starting to come into the carbon credits market as well. People are starting to demand, I think, a higher standard over attestability of claims carbon reductions before they're willing to put a financial price towards it.
Oh, yeah. And you mentioned that you guys have requirements for fintech lenders to be doing business with you, but operating in emerging markets, different jurisdictions, there's different regulatory environments, different regulations. So how is RealFi navigating the different jurisdictions and potential regulations?
Yeah, I'll actually pass over to my colleague Sahil to talk about that in a second. But I think that the first thing to say is that RealFi is not incorporating in each company and finding customers and starting to model them and start lending to them and having to get the required licenses. That's actually for us the wrong approach. The right approach is to find regulated local lenders and to scour the entire market and then have our data models to be able to evaluate these lending companies, these regulated local lenders. So that's how we start, right? We find only companies that pass through our significant diligence and screening process, but also have the ability to lend in those markets. When it comes towards the broader questions of regulation in that direction, I'll actually hand over to Sahil, who can give you some more color.
Yeah, thanks, John. Yeah, hit the nail on the head there. So, of course, our threshold for working with fintech lenders is very high. They must have had, at least 2 years of operation and be licensed within their markets or market of operation. That's the first threshold, of course, to how we work with them. In terms of RealFi itself, the biggest local regulation, meaning within African markets or other emerging markets that we're exposed to, is data protection regulation, because we are handling large sets of data. We take a twofold approach to this. So as a start, we abide by the highest level of international data protection, which is, of course, at the moment is at the EU level, around the regulation that has been set there. But we also follow localized regulation and embed this. So a lot of emerging markets data protection law has emerged out of the EU DPR laws. And so we have that overarching framework. We do not use any PII data. So that's every single piece of data, every loan transaction that is processed through our data analytics system is anonymized. And so, whatever is churned out on the analytics side is highly sensitized to the specifics of the transactions itself. In terms of the actual operational side, when it comes to the fund management or the investment vehicles that are there, we're currently in engagement with leading financial centers in the world, including Abu Dhabi and others, researching and developing solutions for RealFi to actually come to market with a regulated product in the near future.
Great. So I see a question in the chat here. So you guys are facilitating private credit deals between fintech lenders in emerging markets and private investors. There's a question here about how RealFi is generating the revenue. What are the potential revenue streams that you guys are going to have?
Yeah, so I think it's important to sort of restate that currently we've been lending our own capital, but future options for us and the revenue model, which makes sense, is that post-license, of course, that you can basically charge a fee, a success fee, to the asset originators, or these fintech lenders. Within the example I gave earlier of 4G, they could expand the amount of lending activity they could do by 4 times without impingement on the quality of the credit that they originate. So this is a ginormous headache for them to be constantly trying to raise capital and to be able to do it from an international audience. As you may not be surprised to hear, the ability to raise capital in Kenya is a little harder than if you were in London. So they're very willing to be able to pay for access or for the facilitation of the access towards capital. The other side is, of course, on the investor side. Typically what we see in the market is 10% of interest, which is intermediated, is a fee which can be charged. The real question is, what are the vehicles? And to reiterate my point earlier on the working group, we're really interested in sort of talking to a number of different investor archetypes to be able to work on what those vehicles look like. The options are, of course, RealFi could raise itself from its own balance sheet and its own equity base. You can set up a fund structure. They could be SPVs, which investors participate in directly. So there's a sort of whole host of opportunities here, which would enable RealFi to earn some of the yield. But it's sort of an emerging proposition at the moment, and that's sort of why we want to talk to people.
Yeah, and kind of building on that, are there accredited investor requirements, minimum investment requirements, depending on the vehicle? What does that kind of look like?
Yeah, so look, at the moment, of course, we're very much not raising retail capital here. We've deployed our own money, and the next step in the future, post all the things we need to do, would very much be institutional. But a product like this, even once you did create the right structures for retail participation, would most certainly be accredited. So being able to complete KYC and compliance in automated fashion would be crucial to give people exposure to this. And a good comparable here are some of the alternative investment platforms in the United States, like Yield Street. They've done a very good job at creating exposure towards real estate asset classes and alternative investments. And that is, of course, even with Reg D exemptions, etc. This is all targeted towards accredited investors, not anonymous retail.
Yep. And so you mentioned that fintechs are now lending on data versus collateral. There's a question here about if you guys have cross checks to make sure that the loans are actually being used to finance the asset or the agreed upon cause. Do you have anything built in that can help on that one? Or maybe you could speak to the different like data integrations, analytics, things like that that you have going.
Absolutely. So our view is that, we've started at this stage really with data and the ability to ingest and understand these huge loan tapes. Honestly, they're so big, you literally can't even open them in Excel. So this creates like a very obvious place where technology can be used to better understand what risk looks like. But that's really just the starting point. And our entire roadmap is about building additional pieces of technology which further reduce or mitigate or help people to understand risk. So I'll just give you a couple of quick examples on this. As well as the loan tapes, we also want to be able to input or in an automated fashion, the management accounts and the financial accounts, which give us another perspective, which should match actually with the loan tape information. These two should reconcile. In addition to that, integrations with the actual bank accounts of these fintech lenders enable you to match this against physical or actual cash movements. And then the final point is, this is currently an innovation project, is actually enabling the fintechs to deploy capital to a wallet, which we actually provide. So at this stage, the capital isn't going from investor towards fintech towards end borrower. It could go directly to end borrower with all of the data and the reconciliation that we spoke about in the middle. So this is just a tech stack which would dramatically change the amount of risk which you're participating in if you were to provide capital into an emerging market lending opportunity. And this is really the roadmap of RealFi, to continuously build and improve upon our technology solutions to the point where hopefully we can make emerging market credit really boring, where nothing exciting happens. You just get what you expect. But that's, of course, a roadmap and a journey that we've really just begun.
Yep, and kind of on that topic, so what's like the long-term vision of RealFi, given your background? Is there future plans for Web3 to either source capital from on-chain or have a credit protocol built?
Yeah, so maybe for some context here for the people listening, I actually began on this journey trying to design an on-chain credit protocol. And what I sort of discovered across this process is that this was a few years ago. A number of people like Goldfinch had designed interesting Web3 protocols that were very good at the capital allocation piece. They created capital pools, which could then be lent on to lending opportunities. What they were very bad at was understanding what the real world risk of these lending opportunities was. And I'm sure maybe some people on the call here participated in some of these lending protocols, which were generating fantastic returns, 20-ish%. But then, of course, the most popular yield opportunity, Alameda Capital, turned out to be not such a good lending opportunity after all. And at that stage, they were replaced with other lending opportunities. But fundamentally, there is a massive opacity or lack of transparency about what the underlying behavior of these asset classes are. So what we did is we sort of started from the other direction and said, what would the data tools look like that would give one confidence about the actual performance of these assets? And then can we go from there to a successful fintech company which operates within this space? And then can we move towards a credit protocol which enables access towards this asset class, but inherits all of these real world data flows that should be required for an investor to participate confidently. So that's our direction. We want to increase the amount of tools that we have to be able to understand real world risk, and then look at being able to create a generalized protocol where various different people can participate, not just us, but still maintain the integrity of these data flows so that people can have confidence about the risk which they're subscribing to.
Yep, that's great. So that's longer term. In the near term, what's kind of the next milestone? When do you expect to launch the platform?
So let's talk about these two different tracks. The first track is the sort of Web 2 track, where we're looking to expand the number of fintech lenders who we've integrated with the platform and performed all of this data modeling work. We look to expand the amount of tooling which we offer. These are the wallets, the integration to the bank accounts to be able to track cash flow movements. And of course, we look to proceed on our own sort of licensing journey so that we can make it easier to facilitate both private investor capital and institutional capital. At the same time, we have a separate track, which is over this Web3 protocol design. Having lent out capital and having built out a lot of our own models, we're now at a stage where we can start building out what a Web3 protocol might look like. And as I think I mentioned on the call earlier, we are a spin out from the Cardano input-output group. So protocols and Web3 design is something that we've done very well at historically. And we can leverage a lot of that expertise over the design. So we have these two parallel tracks, but I would say the focus at the moment is making sure we're in a place to be able to, in future, be able to funnel capital through the appropriate vehicles and just expand on this risk monitoring and de-risking technology set within the Web2 world.
Yep, and something I forgot to mention earlier when we were talking about the different jurisdictions is there's the obvious currency risk dealing with African countries. How is RealFi addressing that and monitoring that as well?
Yeah, so this is all part of our diligence and onboarding process. To give you an example of a single partner, they provide very short duration lending, and their repayment rates are less than 3% default. But if they're being repaid after a week, they get to turn and relend and relend and relend and relend. So even whilst offering affordable credit, when you get to the end of the year, this can be up to 90% returns in local currency. Because of the risk of currency devaluation, this means they put a huge reserve for potential currency devaluation, which then, of course, impacts the return which a US dollar investor would get. As the macro situation begins to improve, what we'll see is actually greater returns for investors as they can afford to sort of maintain a lower buffer on the currency depreciation side. So that's really what we'd expect to see at the moment. But the way in which we're handling the FX piece is basically only working with companies who have the capability to be able to absorb even the most aggressive currency FX risk.
Yep. And so how should an investor think about the relative risk premium on private credit in Africa compared to the West?
Yeah, I mean, look, you know what, rather than me carry on talking, well, give this to you, Harry, as our senior credit analyst.
Hi, guys. Sure. So the way we like to look at this is when investors look at private credit, they're really comparing it to the more liquid asset class. So you're going to look at private credit in comparison to the high yield market and the leverage loan market. Now, across jurisdictions, obviously, then you map on the foreign exchange risk piece. John has already spoken to that. Basically, we need a set of high-frequency data points with which we can monitor these companies' capital structures and liquidity situations. And if we do that successfully, based on our understanding of the data, we massively risk that situation. I don't have a number in terms of extra premium that you'll get for this, but we're really trying to convert this in a dollar return context into something that where you shouldn't see capital lost based on EM specific factors such as FX risk.
Gotcha. And what would you expect to be like the typical return profile on some of the deals that you're facilitating?
Well, like I can talk about what we've done, which is that across the transactions that we've participated in, we've been seeing returns between 12 and 18% in US dollar terms. With, of course, all this data monitoring and with risk that we're comfortable with. What I'd say is more strategically, as I've said, these companies are leaving huge buffers in because of the macro position and because of devaluation that we've been seeing. So as that situation eases, I expect to see stronger return profiles than that. And I think, the top quartile of VC has returned 21% a year. So as you start to bump up against the top quartile of VCs with a fixed return, I think it becomes quite attractive. And that's not including the measurable impact which can be achieved at the same time.
Yep, definitely. So what do you see as the biggest challenge in the immediate term for RealFi? What's keeping you guys up at night?
Well, I think the first thing in this business is that it takes a long time to build credibility, and it's very easy to lose it. So as a result, we've been very conservative over how we've gone to market. We've really invested very heavily across this data component and building tools that de-risk things. I think that as we go from a Web 2 business towards a Web 3 business, we'll really face challenges on how do you keep other actors who are not yourselves adhering to the same level of rigor that you might have built into your own business. And that as a technology challenge is actually very interesting. Of course, you can create standards, but there are limits to them. So we're spending a lot of time thinking about what Oracle design you might need to be able to have confidence about these real world data streams and to be able to mitigate the behavior of bad actors. Like the example I gave with Maple Finance and Alameda Capital. So yeah, of course, it's very easy to solve for one. Solving for N is a much harder problem, but a very fascinating one, which we've got a very strong team for.
Yep, and we talked about the Web3 things. Are there any thoughts about building a wallet or integrating a RealFi wallet to facilitate these deals?
Absolutely. So one thing which we found is through doing all of this diligence and these data integrations with these fintech lenders, you actually end up in a really strong position of trust where one, they're interested in using your data solutions to improve their own business models. And two, they're really excited to be able to leverage new technology, which they hope will ultimately enable them to raise more capital at a lower cost of capital. So we already have a set of pilot partners who'd be happy to deploy a wallet solution, which would enable us to disperse, or investors to disperse capital directly towards the end borrowers. So yes, we have a number of innovation projects like this, which we're in the business of designing and trialing. And each of them are really designed around solving a particular risk problem, which we've seen has created issues in the market. So we've got this huge risk list with all of the ways things might go wrong and a product roadmap, which works to mitigate each of these risks. Because that's really what we see our business as being, is in the business of understanding and mitigating holistic risk.
Yep, and obviously on the risk side, there's always macroeconomic conditions. How does RealFi view the outlook going forward, and how would you guys, adapt your strategy to change with market conditions?
Yeah, so when we say we've surveyed the market, we really have. So we say yes to very, very few people who might be looking for capital. So we have this huge diligence process and also a set of restrictions over who we'd be prepared to work with. And this really lets you end up with a very effective group of fintech lenders who can manage all of the macro risks, which we can't solve for with data or with tooling. There are just some things that people need to be able to handle. Their businesses need to be resilient enough. They need to have enough of a capital buffer. So we basically screen for this to end up with a set of partners who can weather the various macro storms which can happen.
Yeah, and maybe just quickly to add onto that, on the macro side for the African markets, our whole team, probably 85% of our team are from African markets. So, really deep experience within African markets, understanding them, spending a lot of time here. We do macroeconomic analysis across all our markets of operation on a monthly basis, tracking the key indicators that would influence any positions. And of course, global macroeconomic conditions right now, the Fed rate being the foremost of them, have a direct influence on some of these operations. We actually feel that we will become more competitive as macroeconomic easing comes in the US. Because we can still deliver potential high yield opportunities while the risk-free rate in the US starts to come down.
Yeah, and that brings up an important point. So you guys are focused on African markets right now, but are you guys planning to dive into the West or other emerging markets?
Yeah, absolutely. There's a bit of a sort of trite saying that I think I'm based, by the way, here in Kenya, and I was in Ethiopia for 5 years before. And one thing which people used to say a lot was, if you can make it work in Ethiopia, you can make it work anywhere. And I think there is a lot of truth to this. We're building tooling which should enable you to still manage risk in some of the hardest to manage risk locations. That doesn't prevent us from leveraging this technology for a global audience. And yes, we are actually interested in working with partners in the UK to replicate the model and the tooling to be able to offer exposure there. In general, emerging markets, if you can manage risk, are attractive for the higher yields. Both South America, Southeast Asia would be next obvious landing points from that perspective. But, the technology of understanding large data sets and being able to interpret that within a working capital portfolio is actually global, and we are building global tools.
Yep, that's great. So we've definitely covered a lot. Is there anything that we missed that you guys want to talk about?
Yeah, I think maybe just scanning through some of the comments here. How is yield received monthly, yearly? I do think that one of the huge opportunities here within the Web3 side is actually to create liquidity around this and enable basically daily yields. This would be an aspiration, of course, and it takes a little bit of infrastructure in there. But if you're talking about crypto dollars, then yeah, they are very, very flighty dollars, and people need to be able to earn their return in essentially a live fashion. From the notes that we've been doing currently, a variety of things have been negotiated, but typically quarterly for interest repayments. Maybe maybe just one point here. Why is private credit particularly important in emerging markets? I probably should have started with this, but it's the kind of thing where you sort of live it and breathe it, and then you forget that you need to explain it. So basically, 80% of all employment across, let's just say, Africa is driven from small businesses. There really aren't large corporates. It's really small mom and pop businesses that are the lifeblood of the economy. As you can imagine, institutional banks are not particularly great at providing them with capital. It's not big enough. The banks can earn very strong yields by providing capital towards government gilts. So as a result, they sort of crowd out the ability to finance this absolutely crucial demographic of the economy. So with this dynamic, what we've seen is the emergence of these regulated fintech lenders who've been created to step in and provide capital where the banks have sort of failed to. So the business of being able to finance these kind of opportunities are crucial towards economic growth and employment.
No, yeah, and I think in the presentation you had a figure about the financing gap in African emerging markets. What was that figure?
Well, we've sort of pulled it down. The Venn diagram of a Venn diagram is a $250 billion AUM, not AUM, TAM. But the actual financing gap is, guys, help me out here. It's something like 1.5 trillion.
It's at about 2.3 trillion on MSME globally for emerging markets. For Africa, you're probably looking at about half of that.
Yeah, that's an enormous market. Well, we're coming up on a couple minutes left. There's nothing else you guys want to talk about.
Maybe just a final comment of we're building very quickly. We're doing exciting stuff, and we really would love to talk to you. So my email, I'm sure the Fundstrat people can share it, but it's john.o'connor@realfi.co. But I'm sure we can send that around. If you're interested in joining our working group and learning more, in really being a part of what we're building, we'd love to hear from you. So that's my call to action. Get in touch.
No, yep. And to add on to that, if you want to reach out to myself or Sean, we're happy to put you guys in touch with whoever you need to. Thank you guys for joining. Thank you for taking the time today. This was great. Thanks a lot,
Thank
John.
you very much for having us.
So much.